Now we're back for 13, and 13 is switching gears, and we're going back to these uncollectible accounts for accounts receivable. This one is saying they're using the aging system, and they've re-aged or reevaluated all of their accounts receivable, and they have found that after doing these calculations, there is a total of a certain amount needed, which is going to go here. You have an unadjusted, this is what your balance is right now. You're going to need that, make that balance match what you find from this group of aging. And then it asks you to do the journal entry for that. So what you would look at is this difference, okay, becomes the expense, and we have to add to the allowance for bad debts, doubtful accounts. And then it asks you to kind of visualize and do a T account for this for the journal entry. And what would that adjusting entry be, which is this one up here. Finally, they come down and say, okay, now what would this look like on the balance sheet? So you would have to look at what is the total of your accounts receivable, which it looks like, does that give you that number in the activity? Yes, it does give you that number. It's 170,000. So the net of the allowance it is that 170 minus the 12,620, and that can be shown two ways on a balance sheet. It can be shown with just a notation about what the doubtful accounts is with the net over here, or this is the way I like to show it. Show the full accounts receivable minus the allowance, and it gives you the net over here. This is much cleaner, I think, as far as being transparent and helping your readers understand your statements. In 14, what are we doing? 14, we are looking at, I do not do. We're going to go on and do 15. And 15 looks at a loan, and it's going to ask you to record the bank's viewpoint on it. Okay, it's an $80,000 note receivable. So they're going to ask you to give the journal entries for the bank or whoever has put out the loan. So, you know, that's a kind of a standard entry, an $80,000 debit and cash credit. And then you're going to look at the receivable, the interest receivable. And it's 11%, which is high, for 8 months. So that's going to show as a receivable and a revenue, whether they have received that or not. Okay, this is where you're looking at adjustments. The bank is adjusting for the accrued interest on that. And then when it's paid, they're asking you, okay, so what is the full amount that's going to be paid? It's going to be, you know, the $80,000 plus the $80,000 in the interest. And then, see how you've done the receivable up here? So you're going to have to reverse that receivable. This is the amount of cash you've got. You've already got part of that in a receivable that you're going to take out, and now you're going to show the actual revenue here of only 4 months. You see the difference here? You have 11 months here, and then on the 30th, well, you have 8 months here, I'm so sorry. You have 8 months here, that took care of that year's interest. You've already recorded that. Alright, we've already recorded that as revenue. So it's really important to remember that. So now we've come down on April 30th, and they're paying it off. You're receiving this cash. This receivable is still out there, so you need to get rid of it with a credit, and you need to record the 4 months of interest that is for this year, and that would be recorded as revenue. And then that would take care of that entire note. Do that in T account so you can see how that works. And in the second requirement, they're going to ask you who has the note receivable and who has the note payable, who has the revenue and who has the expense. And that would be the bank or Sperry. So kind of figure out who gets what account, and you'll have to think about that. And then you're going to look at your an early payoff, it looks like here. So that should be kind of interesting to play with. Email or message if you have problems. And that wraps up 9-1 because we don't have to do 16. So I will see you in 9-2 here directly.